Thank you. Morning, everyone. Many thanks for joining us at this fairly short notice. No doubt you've seen the press release earlier this morning announcing our agreement to acquire the dual loan portfolio from NAMA. With me in the room is Tom Drakesmith and Peter Cole, and in addition, son Betty, the two latter who have been heavily involved in the transaction. Shortly, we'll open the floor to take questions, but first of all, I'd just like to take you through the highlights and detail on the transaction. So you should be able to see a presentation on your screens. Turning to slide 2, the transaction gives us a major new platform of high-quality retail real estate in Europe's fastest-growing economy. It'll increase the size of our gross asset value by over 10%, immediately providing us with a market-leading position in an attractive European territory, and give us access to another super prime centre the size of Bullring in Ireland's preeminent Dundrum Centre. We're making this acquisition as part of a 50-50 joint venture with Allianz, with whom we have a long track record of working closely with at Nice Étoile and Espace Saint-Quentin in France. The transaction entails acquiring a package of loans secured against market-leading property assets, and we have a clear strategy in place to move forward swiftly with a route to owning the assets. The crown jewel asset within the portfolio is Dundrum, a 1.4 million square foot shopping centre to the south of Dublin, which is a super prime retail and leisure destination. Now, these types of opportunities are rare, and I'm pleased that we were in a position to act quickly and innovatively to take advantage of this approach to growing our business in a competitive investment market. The pricing on the underlying real estate offers an equivalent yield of 4.2% and attractive IRRs in the region of 7 to 8% pre-development, as well as immediate earnings per share accretion and underlining compelling financial metrics. So moving to slide 3. This transaction ticks all the boxes and is in line with our ongoing strategy to be the best owner, manager and developer of retail property within Europe. The assets underlying the loans are premium, high quality and well positioned, maintaining the high calibre of our European shopping centres. The transaction swiftly fulfills our ambitions to grow our scale within Europe, and Ireland is an extremely attractive end market to be in. Having turned the corner after the downturn, it now has some of the strongest macroeconomic fundamentals in the Eurozone, and the growing consumer backdrop and falling unemployment is supporting the highest forecast rental value growth of any European city. There's a clear opportunity to establish the market-leading retail property operation in Ireland, and we're excited about the potential to deploy asset and development management initiatives and benefit from the considerable overlap with our existing portfolio. Whilst representing an excellent strategic fit, the deal also offers the potential to generate significant shareholder returns. Now, slide 4. Looking at the economic fundamentals, the market has now shifted into a period of high growth. Ireland now boasts the fastest GDP growth in Europe, and the unemployment rate has decreased by 4 percentage points over the last 2 years to below 10% today. It continues to attract many high-growth technology companies thanks to the favourable corporation tax and highly skilled workforce. These trends translate into higher disposable income, driving a continued period of growth in retail sales over the last 3 years, with sales over the last 12 months registering a 7% uplift alone. Now, slide 5. Dublin continues to represent the central commercial hub for Ireland, accounting for around half of the country's GDP, and forecasters predict the highest rental growth of any major European city. Grafton and Henry Street represent the main comparable rents for prime retail space and have seen growth start to emerge on the back of low vacancy and the favourable backdrop. Grafton Street alone registering rental growth of approximately 12% over the last year. However, as you can see, with rents still below through the cycle average levels, there is a compelling case for significant future rental growth. Now, turning to slide 6, you will see that the centres make up the portfolio of properties sit in 3 key locations across the city. Dundrum and the adjacent Phase 2 development site is to the south of the city in the affluent area of Blackrock and Ballsbridge. This southern suburb is densely populated, providing a catchment of close to 2 million people and an available spend of some €2 billion within a 30-minute drive. Swords is to the north of Dublin in another densely populated suburb and close to the airport and a number of the headquarters for multinational companies. And finally, Ilac and the central development site sit in the heart of Dublin's retail zone alongside the main retail high streets of O'Connell and Henry Street. Now turning to slide 7, overall the portfolio provides access to a combined 2.2 million square feet of additional prime space, including a number of significant development opportunities. Dundrum naturally represents the lion's share of contracted rent, and total rent across the portfolio equates to €45 million. But we feel confident that there is substantial reversionary potential at Dundrum of around 15% in the near term. Aside from the 50-50 partnership with Allianz for the Dundrum asset and development site, Hammerson also has exposure to 100% of the remaining loan portfolio, including 50% stakes at the pavilions in Swords and the Ilex Centre, and 100% of a 6-acre development site at Dublin Central. Now, turning to slide 8. For those of you who may have visited Dundrum, you know what an impressive retail and leisure destination it is. It has all the characteristics of a premier centre, with Harvey Nichols, House of Fraser, M&S and Hamleys anchoring it, as well as an impressive lineup of international brands and large amounts of catering and leisure space. It is the gateway for international brands entering Ireland for the first and only House of Fraser and Harvey Nichols in Ireland. Other firsts have included the first Hollister, H&M, Michael Kors and James Italian. Offering larger modern units compared to the smaller spaces on Grafton Street, Dundrum also plays host to a theatre, event space, medical centre and a radio station. It's truly a modern retail and lifestyle destination. And Dundrum sits alongside our own Bullring in terms of size and value, and would arguably represent another crown jewel to our portfolio. So moving to slide 9, despite its high quality lineup, the centre also is sitting on a significant amount of rental reversion potential. Stores at Dundrum are often at the top quartile of individual retailers' portfolios, trading on a par with stores in Marble Arch or Birmingham. In 2013, 14 key lettings with the likes of Michael Kors, Mint Velvet and Jack & Jones moved up Zone A's from around €3,000 per square metre to €4,000 a square metre. However, the rental tone at Grafton Street has moved up recently to close to €6,000 a square metre. And through new lettings and the rent review process, we believe there is the opportunity to capture material short-term reversion. From our discussions with existing retailers, we have identified a number of international brands not yet represented in the Irish market. And we've highlighted a few on the right-hand side of this slide, and we're confident in our ability to leverage our strong relationships with them. I'll hand over to Tymon just to talk through the financials.
Thank you, David. Good morning, all. I'd like to explain the financial details behind the acquisition. The loan acquisition is being made by a 50-50 joint venture between Hammerson and Allianz, and the purchase price is €1.85 billion or £1.37 billion. So Hammerson's share of this initial transaction is a little over €900 million or £0.69 billion. Under our agreement with Allianz, the property portfolio is segmented so that we will jointly own Dundrum and Dundrum 2, and Hammerson will acquire all the other assets. This means our share of the financial allocation of properties is over half, and totals an estimated €1.2 billion or about £0.91 billion. Included in this total are forecast tax payments and various transaction expenses. The real estate assets, excluding development sites, which make up this investment, provides an initial yield of 4% and a reversionary yield of 4.6%. With rental growth, we estimate the transaction will generate an ungeared IRR of between 7 and 8%. Moving on to the next page, as you just heard, our share of the final property portfolio consideration is 1.2 billion euros, or 0.91 billion pounds. We plan to fund this investment from our existing financial resources and a targeted disposal program of 500 million pounds. We've arranged a new 1 billion euro revolving credit facility, which with existing credit lines gives us plenty of liquidity. This bridge facility will be repaid by a combination of disposals and terming out the credit facility by capital markets issuance. Over recent years, we've raised over £1 billion from Eurobonds and US private placements. Already in 2015, we've announced £155 million of property sales, well above book value, and we've accelerated planned disposals and currently have £200 million of properties on the market, with a further £300 million planned for the first half of 2016. We are committed to maintaining a strong investment-grade credit ratings, and the disposals are expected to bring Hammerson's LTV to a level of mid-30%, as shown in the chart on the right hand of this page. So this exciting acquisition can be funded very comfortably given our strong balance sheet. And with that, I'll hand back to David for concluding remarks.
Thanks, Simon. So to wrap up, this really is an exceptional transaction for the company. It provides access to the best shopping centre and the most significant development sites in Dublin, in the fastest growing economy in Europe. I think it's bang in line with our stated strategy and will provide attractive financial returns going forwards. With that, hand over to you all for your questions.
Thank you, sir. Now, ladies and gentlemen, if you would like to ask a question at this time, please press the star or asterisk key followed by the digit 1 on your telephone. And please ensure that the mute function on your phone is switched off to allow your signal to reach our equipment. If you find that your question has already been answered, you may remove yourself from the queue by pressing star 2. Again, it's star 1 to ask a question. And now we start with the first question. It's from Christopher Fremantle from Morgan Stanley. Please go ahead.
Oh, hello, good morning. I had two questions. One was on your disposals. Can you just be a little bit more specific where those disposals are coming from? Are they from your retail parks portfolio? Are they shopping centres? Are they in France or the UK? If you could be a little bit clearer on how and where they're coming from. And the second one is just, I know you don't tend to focus so much on occupancy cost ratios and rent to sales ratios, but if you could just give an idea of the affordability of the rents as they currently stand versus retail sales, that would be helpful for the assets you've purchased.
Thanks, Chris. So of the sales that we're earmarking, as we said, 200 million is on the market and 300 million to come. Just worth pausing, reflecting, we have obviously contracted on 100 million of disposals but not yet received at Angers and Bercy-Deux, so that will come in the next few weeks. 200 million in the market, that is mainly from UK retail parks and a smaller asset in France, and then going forwards, the additional 300 million will be, again, in the main from ex-growth retail parks and smaller assets on the continent. Then, in terms of affordability, rents, so we assess the OCR on the core properties within this portfolio at around 13%. That reflects and compares well with our wider portfolio, which is around 15% in the UK. And as we've said, we believe with retail sales growing at in Dublin around 7%, with already an identified reversion of some 15% on the current rents, and there being additional headroom when compared with streets such as Grafton Street, we think the prospects for rental growth are very significant.
Thank you.
Our next question comes from Charles Boissier from UBS.
Yes, good morning. I just have two questions, please. The first one is, may you have to negotiate with the borrower of the loan, or is pricing fully fixed and finalized, given you're actually acquiring loans rather than directly the underlying asset? And then the second one is, could you just expand a little bit on the rent reversion? In particular, I just was wondering because I think you had to renew, or the leases were renewed in 2015. So does that mean that most of the rent reversion actually come in 2020 now? And then you compare your asset Dundrum relative to Grafton Street. Could you just expand what makes you confident that the prime retail street is a relevant benchmark, and what is the sales productivity of Dundrum versus Grafton Street? Thank you.
Okay, so the first question around the route to the real estate. I think it's fair to say we are very confident of ultimately acquiring the real estate. We've done a significant amount of work around that. This is a fairly well-trodden path in regards to loans that are in default, and it's worth remembering that this is the route we took earlier this year in acquiring a major stake at the Whitgift Centre, so we have done this before. Our approach is we anticipate, and our primary target is to do a consensual deal with the borrower. We know them from old. We have met them with NAMA through the process, and obviously we will engage with them once we have acquired. But I think it's in everyone's interest to undertake a consensual deal, and we've assessed what that would mean financially for the business, and that's incorporated with the pricing we've issued. And worth saying, there is a plan B, which one can take a legal route through enforcement. We're very confident of that. Should that be needed, that would take a little bit longer, but even in that regard, we would anticipate getting access to the real estate by the middle of next year. Worth also just mentioning, we obviously receive interest on the loans in the near term. That gives a coupon of about 3.5% in the short term. Then a question about comparing with or the rental levels and the reversion, the reliability. So there is a 2015 rent review cycle ongoing at Dundrum, so there is some uplift to come through that, but equally, whilst the assets have been very well managed by the current owners, they have been somewhat constrained during the NAMA process, so we believe there are a number of leasing and asset management initiatives can be undertaken over the next 18 months or so that would generate rental growth, but there is an element of the reversion that will come through, you're right, on Dundrum in 5 years' time through the rent review process. Then in terms of comparison with Grafton Street, I think in many ways I would, and it's wrong to compare streets across the world because no streets are the same, but Grafton Street is a sort of approaching Bond Street offer, whereas Henry Street, which adjoins our main scheme, certainly in the Ilax Centre, but also is a good benchmark versus Dundrum. This is the Oxford Street equivalent, 30 million visitors a year. This is where people in Dublin spend their money on fashion and other goods, and we see very good demand for space in those areas. And I think the read across for Dundrum is very appropriate. Rents in Grafton Street now approaching €600 a square foot, and as we said in Dundrum, currently at €375 a square foot, with a reversion about 15% above that. Simon, do you want to add anything in terms of the assets?
Yeah, it's a good question, Charles. I think one of the issues in comparing with Grafton Street is that the composition of the street is quite different. You know, Grafton Street is a historic street. The retail units are somewhat constrained in their configuration, and we're beginning to see a shift towards Dundrum becoming the landing point in Ireland for international retailers, more so than Grafton Street, because the retail footprints are more appropriate. What also came through from our tenant audit as we were going through the due diligence process is that many of the mainstream operators in Dundrum that also have locations in other areas of central Dublin confirm that Dundrum is either their best performing or amongst their best performing stores in the country. So although we don't have any specific detail on the productivity of Grafton Street, by triangulating various data points, we're pretty confident that Dundrum is probably the best performing retail location in Ireland.
Interesting, thanks.
From Societe Generale, we got Mark Mozzi on the line.
Yeah, very good morning, gentlemen. I have two questions on my side. First one is, what is the initial yield of your acquisition on the asset side, including the value of the land of the development site? I understand 4% is only related to the assets, but what will be the cash-on-cash initial yield, please? That's my first question. And the other one is, what will be theoretically or on your initial assessment, the development cost for Dublin Central and the potential calendar you have in mind at this stage? Thank you.
Thanks, Mark. Well, if you include the development land, the non-income producing, the cash initial yield is about 3.7% for the portfolio. In terms of the developments, I really think it's too early to put capex to these schemes. You know, there is 27 acres of opportunity here, development opportunity, about 3.75 million square feet of consented or previously consented developments. But to be clear, you know, these need a lot of work. We need to evaluate them. These are medium-term development opportunities, and I think at this stage, both the configuration, the amount of retail and other uses will be looked at, and therefore the capex will obviously follow on. So I think too early really to give you a steer.
Yes, thank you very much.
Our next question comes from Robbie Duncan from Numis.
Morning. Could you comment, please, on the coupon on the new 1.5-year bridge facility? I've got other questions, but I'll take them one at a time.
Simon?
Morning, Robbie. So the new facility is very similar to the one that we signed in the spring with a margin of around about 1%. It's a euro-denominated facility, so it's benchmarked against very low euro interest rates. I think for modelling purposes, though, you should assume the debt component of the funding of this acquisition will be termed out in the bond markets at around 2 to 2.5%. Because the bridge is only going to be in place for a relatively short period of time. So if you think there's £900 million worth of funding required, £500 million comes from disposals. Why don't you assume around about a 5% yield on those disposals? The £400 million remaining will be funded in the medium to long-term euro debt markets at a coupon of between 2 and 2.5%.
Okay, thank you. And just coming back to the question around the rent review cycle, I think that was Jonathan's question. Could you just give us an indication of what underlying lease structures are? Are they comparable to those in the UK? You talked specifically at Dundrum about having an upward-only rent review clause or structure on 90% of the leases. But does that mean the rest can go up and down? Are the rest of the centres, the other two centres, do they have upwards only or upwards and downwards clauses? Is there any index linkage? Could you just help us understand a bit more about the structures?
Yes. Robbie, you may not be aware, but a few years ago in the downturn, the Irish government undertook a change to the law, which effectively meant that any new leases that were entered into have an upward and downward rent review configuration. So existing leases have upward only, and that's where the broadly 90% figure comes in. Any new leases will be subject to upward and downward rent reviews.
Okay. And that's a standard 5-yearly rent review cycle, just to confirm.
Yeah.
Yeah.
Yep. And yeah, as I say, a fairly attractive weighted average unexpired lease term of around 9 years.
Okay, just the last question. Obviously, 4% is, on the headline, a relatively tight yield. I appreciate there is reversion in there. I think you referred in the start of the presentation to 4.2% equiv. I remember various comments that were made back just over a year ago, partly by yourselves, about the yields that other people have been paying. I mean, how could you sort of square that circle that, 4% to enter a new market? I appreciate that it'd be very difficult to replicate this portfolio on the open market. But clearly, does that mark a step change in your thinking? Because I can't see a huge further scope for yield shift from current levels.
Yeah, but Robbie, we're not buying this for yield shift. I've been saying very clearly for the last 5 years, this business is about operating efficiently and at top of its game in terms of driving rental growth, and that's where the real opportunity in the existing assets comes here. 15% reversion on Dundrum, very achievable, and we'll look to exceed that through other asset management initiatives. And then on top of that, you layer in the very significant development opportunities. I genuinely can't think of another opportunity which brings a top 10 European asset into our portfolio and 27 acres of development land, still off a good cash yield that comfortably beats our cost of borrowing. So I think it works fantastically well for the company, and I'm stand by the strong financial returns that we've set out in the release.
As the last question then, just coming back onto the developments. Clearly, it's too early to give us a sort of a firm figure for a yield on cost. Would you expect them to be ahead of the yields on cost you're getting on your UK stroke French developments?
I think it's too early to say. I think that on the basis that economic growth is very strong, retail sales are growing at the highest rate of any capital city in Europe, then I think the propensity to grow rents are as strong as anything in our portfolio. So that would, put an upward pressure on that yield on cost equation. So we'll certainly be targeting a higher figure, but I think it would be wrong. Bear in mind at this early stage of the evaluation of the schemes, we haven't really focused in on what we're going to build.
No, understood. Thank you very much indeed.
We take our next question from Oliver Creasy from Green Street Advisors.
Good morning, guys. Just one question from me, please. You mentioned that the EPS, this deal will be EPS accretive from day one. Just curious, is that still going to be the case when you wind forward 18 months and you've repaid the debt facility with equity raising? And if so, or if not, indeed, could you just quantify a little bit how accretive the deal will be both before and after from an EPS perspective? Thank you.
Yeah, it's Simon. I gave you some modelling hints a couple of minutes ago. So we're acquiring £900 million of real estate once we get to the properties. We assume that the income-producing element of that, which is the vast bulk, offers an initial yield of 4%. We're funding it through £500 million worth of disposals. You can assume an initial yield on that £500 million of 5%. So the remainder would be funded in the euro bond market at around about 2 to 2.5%. So if you do all of those maths, you'll find that there is a little bit of uplift to net income. During the course of the disposal program, we'll be looking to implement our asset management plans and drive the rental levels in various parts of the Irish portfolio. So we're comfortable that it will be modestly accretive in the medium term as well as the short term.
Okay, thanks. Just to clarify, so am I incorrect in thinking that you're expecting to be raising new equity capital in the next 18 months, or have I got the wrong end of the stick there when you repay this facility? I'm sorry. Yes, I am.
Yeah, the funding plan for Dual is very clear. There's £900 million to find, 500 million pounds are from disposals.
Yep.
400 million pounds are from repaying the initial bridge credit facility by terming out that debt, probably in the bond markets. This is a
Understood.
disposals and debt funding.
Okay, yep, got it. Thank you.
From Debtwire, we got Bert Tenkate on the line.
Morning, gentlemen. Just a quick follow-up on the bridge facility. I was wondering if you could provide a bit more information on which bank or which lender provided the facility, and also on your joint venture partners' financing. Thank you.
I think it's commercially sensitive. I mean, I don't particularly want on this call to talk about the banks who are involved. We welcome their support and their long-term relationship, banks who we've done business with for many years. I'm not sure it's the right thing for me to be disclosing the names and the terms of the facility, but we're very comfortable with what we've achieved. As far as Allianz is concerned, you're best off asking them, but they're obviously a huge, well-regarded organisation who I think have got ready access to the debt markets.
Thank you.
Before we take our next question, just a quick reminder to ask a question at this time. It's star 1 on your telephone keypad. And now we come to Michael Bird from Exane BNP Paribas.
Morning, guys. Thank you for the presentation. A couple of questions, if I may. The first one is just on the rental growth potential, I guess, you see in the rump of the portfolio other than Dundrum. If you could talk about that, that would be very useful. And then the second question, I can kind of understand your enthusiasm for sort of getting into Dundrum and the asset management potential you see there. I mean, what happens between now and you taking ownership of the assets in, let's say, summer of next year? I mean, can you get involved in the asset management side ahead of then, or are you effectively sort of locked out the assets until next year?
So in terms of the wider assets, these are well-run, well-let assets, so around 98, 99% occupancy. So, this is not all about Dundrum. There is great potential in those assets. They, both ILAC and Pavilions, adjoin major development sites. I talked about earlier, so ILAC adjoins Dublin Central, which itself is a 5.3-acre site, so that will drive future opportunity in ILAC. And at the Pavilions, that adjoins a 16-acre site, so again, that will drive the asset performance there. But we believe there are good opportunities for bringing in additional retailers, additional catering, and bear in mind you're starting at rental levels 100 to 200 euros per square foot, so very affordable for the retailers, and OCRs very much in line with the figures I gave earlier. So overall positive. In terms of the what happens, and the answer is, well, very shortly we will engage with the borrowers. As I say, they are a very professional, highly regarded outfit. Created Dundrum itself, one of the best assets in Europe, and they run the other assets exceptionally well. So we will be engaging with them, and I would say it'd be business as usual going forwards in terms of running of those assets.
Thank you, guys.
Our next question comes from Tim Leckie from JP Morgan.
Hi, sorry, I didn't know how to exit the queue. My question was on funding, and it has been answered. Thank you very much.
Thanks, Tim.
Thanks.
Then we come to our next question from Oliver Reif from Deutsche Bank.
Thanks. Just a quick one from me on the asset optimization and how quickly you think you'd be able to take advantage of that. For example, through improving the food and beverage offering, if you can give any guidance on when lease renewals are scheduled for. Many thanks.
I think this is a complex situation, very large asset, around 1.5 million square feet. So the expiry profile, particularly on the catering, is very varied. Some very short-term license arrangements, some longer-term leases, and we're looking to increase the amount of space for catering. There's obviously external areas as well where we may introduce some other leisure and catering. So I think, without going into almost line by line, unit by unit, what I would say is over the next couple of years, we're very confident of capturing a substantial part of that reversion. Some will follow on in terms of rent reviews, but we are aware from our due diligence and from the discussions we have with all of those, particularly retailers and caterers across our own portfolio, they see a lot of appetite, no pun intended for the caterers, for getting into Dundrum, Ilac and Pavilions.
Thanks very much.
From Barclays, we got David Prescott on the line.
Morning. Two questions from me. The first one is you guide to a 5-year IRR ungeared of 7 to 8%. Does that include the development prospects? And if so, how much of that is in that kind of IRR?
Yeah, no, simple answer, no, it doesn't include the development prospects. We haven't included the capex, so we haven't included the returns. And as I said, just to caution, these developments are for the sort of medium term, really. So, if anything, it would be at the latter end of a 5-year IRR. So, we're focusing that 7 to 8% unlevered IRR just on the current income-producing assets.
So we could read into that, if there's no yield shift, a kind of 3 to 4% rental growth for the next 5 years.
Correct.
My second question is on the kind of potential supply in this space. So you have a very big development opportunity available to you. I'm not so familiar with the Dublin market. How many other opportunities are there around Dublin for reasonably big retail schemes? And have you got the only one?
Yeah.
Yeah, I mean, relatively few is the answer. And obviously when evaluating development opportunities, it's partly about looking at the wider market context, but it's also about understanding the qualities and the particularities of the individual opportunities. So if we just think about each one in turn, I mean, Dundrum Phase 2 clearly provides a whole range of opportunities from an extension to the existing asset right through to a more residential-led scheme, given its proximity to Dundrum town centre itself and the transport infrastructure. And I'm sure you're well aware of the recovery in the Irish housing market, particularly concentrated in Dublin. So there's a number of opportunities around that particular site that will be difficult to replicate elsewhere. In terms of Swords, there are development lands located adjacent to the existing shopping centre. There's a previously consented retail extension, a substantial project. M&S actually committed to that extension some years ago, which gives us a lot of confidence in the ongoing tenant demand. Again, incredibly difficult to replicate given it's directly connected to a well-let and successful centre. But it's Dublin Central that we really feel excited about. This is a 6-acre site right in the middle of Dublin, directly alongside its busiest retail street. You've already got a strong retail presence on Henry Street itself, the Ilac Centre and O'Connell Street. So, in aggregate, there's very little retail supply coming forward. That's certainly the case in central Dublin. And setting all that aside, this site is so special and well located that we think there's really quite an exciting opportunity to be delivered there. So I think we feel confident about the portfolio in its totality, and we're excited about delivering the developments in the medium to longer term.
Great, thanks.
Our next question comes from Sue Munden from Panmure Gordon. Please go ahead.
Thank you. Good morning. Just another quick one for Timon on the funding. It looks to me like the percentage of euro debt is going to skew your natural hedging a little. Just wondered if you could comment on whether that will be reorganised or whether there will be a lower percent hedging against the euro in the portfolio going forward.
Morning, Sue. Well, you're right to say that by this transaction we're likely to increase the euro-denominated asset base because we're acquiring a bit more than £900 million worth of euro properties. and will likely sell some sterling-based centres and parks here in the UK. The debt that we're going to take on, I'd imagine, will be predominantly euros, because we will look to maintain our hedge of around about 80 to 90% on the balance sheet. We always have the ability to use foreign exchange swaps in order to optimize the mix of sterling and euros. So I don't see this transaction as changing our long-term guidance of being in that 80 to 90% hedging range, which allows us to give a degree of consistency to our sterling-based NAV per share growth and our sterling-based dividend policy, which remains at a guidance growth rate of between 6 and 8%. So I think we can fund this consistent with our own guidance and provide further support to growth in net assets and dividends.
Great, thank you very much.
Our next question comes from Alison Watson from Investec.
Morning. Just one quick question from me, please. Hi. Press reports suggest that iPut Irish Life may exercise preemption rights on the Pavilions and ILAC assets. Can you comment on that, please?
Well, remember, we're acquiring loans in the first instance, so no change initially. We've had some conversations with both JV partners on those two assets. We welcome a relationship with them. We think we're confident of working with them in the longer term. I don't think it's really any further comment than that. We're confident of what we bought, and ultimately see this as a long-term investment.
Okay, thank you.
As there are no further questions in the queue, I would now like to turn the call back to David Atkins for any additional or closing remarks.
Yeah, well, look, everyone, thanks for your time. As I said at short notice, I think a major transaction for the business, a major step forward in terms of our European exposure, increasing gross assets in one step by 10%, providing that access to one of the best shopping centres in Europe, plus the development sites you've heard. We're very excited by it. No doubt we will keep you all informed. We will arrange for a visit at some point to Dublin, so keep tabs on that. But for the time being, thank you for your support. Thank you.